Welcome to the session, everyone. Today we're diving into the challenges and opportunities of managing natural catastrophe risks across Europe.
Yeah,
These
absolutely.
discussions really mix policy, economics, and climate change in a very intricate way.
I'm excited. What's the gist of the issue here? Is it mostly about rising losses because of climate events?
Exactly. You see, economic losses from extreme weather and climate events have been skyrocketing. Over the past decades, the EU has seen um, about 900 billion euros in direct losses. And what's striking is that one-fifth of that happened only in the last 3 years.
Mm-hmm.
This trend is largely driven by economic exposure growth, more assets in high-risk areas, and of course the impact of climate change making events more intense and frequent.
So wait, a lot of these losses aren't even being insured, right?
Yes, exactly. Only around a quarter of these economic losses have been insured historically, and in some EU countries, the insured share is below 5%. Imagine that. The vast majority of the risks fall on households and the public sector.
Right.
This, in turn, slows economic recovery, strains public finances, and even hikes up banks' credit risks.
That definitely sounds critical. What then are the proposed solutions to bridge this insurance protection gap?
Well, they propose a multi-layered approach, kind of like a ladder that builds on both private and public interventions. At the core, they've identified two key pillars. First, an EU public-private reinsurance scheme designed to pool risks across the EU and across various perils. And second, an EU public disaster financing mechanism aimed at supporting reconstruction efforts for public infrastructure after major disasters.
Yeah, I follow. Interesting. So the EU reinsurance scheme is in a way an additional layer of risk sharing?
Exactly. It's like a safety net that complements the existing national schemes. It would um, enable insurers and even national schemes to transfer some of their peak risks to this shared pool. The idea is that risk-based premiums and potentially instruments like catastrophe bonds would help lower the overall cost of
Mm-hmm.
reinsurance.
And what about this EU public disaster financing component? How does it differ?
That pillar works more directly with governments. It's designed to provide immediate fiscal capacity to rebuild public infrastructure when disasters hit. The funds would come from risk-adjusted contributions by the member states. But importantly, disbursements would be conditional on, implementing prevention and risk mitigation measures.
Right, that seems to instill real accountability. But doesn't that open up a risk of moral hazard? I mean, couldn't governments feel too cushioned by such funds and possibly delay implementing proper risk prevention?
That's a good, fair point. The proposals actually emphasize strong conditionality. Payouts are tied to pre-agreed national adaptation plans and risk mitigation strategies, ensuring that governments keep their
Yeah,
skin in
that
the
makes
game.
sense.
It's all about balancing support with incentives to invest in resilience.
I also noticed that national insurance schemes in some countries play a big role. How do they fit into this picture?
National schemes are fundamental. Countries like Belgium, Spain, and France have um, mandatory insurance elements that boost coverage penetration. The study found that places with these schemes tend to see insured loss shares around 47%, compared to below 18% without them.
That's
These
a really
national
noticeable
frameworks
difference.
serve as a base, which the EU-level solution would then supplement to further improve risk diversification and pooling.
So essentially, we have a layered system where individual insurance, national schemes, and an EU pool work together to manage the risk more efficiently.
Precisely. Think of it like building a multi-stranded rope. Each layer reinforces the other. The EU proposal isn't meant to replace what national schemes offer. It's intended to expand the risk pool internationally, which can lead to significant cost reductions thanks to diversification
Right
benefits.
on. Speaking of cost reduction, how do risk pooling and diversification really cut premiums down for policyholders?
It's interesting. When risks are pooled across various countries and perils, the capital needed to cover extreme events goes down. For example, a simplified exercise showed that pooling flood risks among 12 countries could potentially reduce the premium cost by around 26%. That's because the extreme events are less likely to occur simultaneously everywhere.
That's a powerful dummy for diversification. That's impressive. But I'm also wondering, given the diverse national practices, won't there be difficulties in harmonizing these schemes across all member states?
Absolutely. That's one of the big challenges. National practices vary considerably. Different countries have different mandatory elements, pricing mechanisms, and risk assessments. So, any EU level solution would need a baseline of common rules. The proposal, however, stresses that participation in the EU reinsurance scheme would be voluntary, which helps preserve national
Yeah,
autonomy.
that voluntary element is key. It means national solidity isn't forced to change radically. Right, it seems to be a complementary structure rather than a one size fits all solution. What about the role of private market dynamics here? Are insurers comfortable with this extra EU layer?
The idea is to support rather than compete with private insurers. The reinsurance layer would be market based. It would rely on risk based premiums, and ideally, it would allow private insurers and reinsurers, along with national schemes, to tap into additional capacity when needed. Plus, by involving capital markets through cat bonds, the EU scheme could share the risk widely.
That reassures them. And then, on the public side, there's the Disaster Financing Fund to support the reconstruction of, say, critical infrastructures like roads and bridges. But how do they ensure that public funds aren't misused?
Good question. The fund is designed with strict payout conditions. Funds are released only after governments meet specific prevention and adaptation criteria. For example, a government would need to have submitted a robust, approved national adaptation plan. This conditionality is aimed at reducing moral hazard while ensuring that the funds directly target the rebuilding of public assets that are, frankly, too critical to leave uninsured.
Right, that should keep the incentive structure in balance. It all sounds quite comprehensive, but do you think these EU solutions could actually lower the overall cost burden of natural disasters on the economy?
Definitely. By enhancing insurance coverage and pooling risks, the proposals aim to lessen the immediate fiscal shock to both households and governments. Better insurance translates into faster recovery times, reduced credit risks for banks, and less reliance on emergency public aid.
That holistic impact is crucial. It really is a rethinking of disaster risk management for our modern age. However, I wonder if, in the rush to design these mechanisms, there's a risk that some of the finer technical differences between countries might get lost.
That's a very fair critique. The proposal, while aiming for cost efficiency and pooling benefits, does acknowledge that any EU-level system must carefully align with national structures. It's designed to be complementary, so national schemes remain front and center for local needs. There will undoubtedly be negotiations on harmonization details.
Indeed, no one-size-fits-all solution here. It's a balancing act between standardization and national specificity, eh?
Exactly. The proposals lay down principles like supplement, not supplant, and stabilize, not subsidize, to ensure that national and private initiatives aren't undermined. Meanwhile, the EU layer would only kick in to cover those risks that cannot be efficiently managed within national borders.
That's a delicate but necessary balance. So, overall, we're looking at a multi-layered risk management approach that leverages both public-private innovation and extensive pooling, almost like an insurance ecosystem.
Precisely. It's about creating an ecosystem where, through cooperation and coordinated policy, insurance coverage improves substantially while reducing moral hazard and keeping public spending in check. In effect, it could help Europe become more resilient amid the escalating impacts of climate
Yeah,
change.
that's the vision. This certainly seems like a forward-thinking blueprint, even if its practical implementation will be challenging.
Absolutely. Political will, legal frameworks, and technical cooperation will all be critical. But given that Europe is the fastest warming continent, innovative approaches like this might be our best bet to manage the economic fallout from natural catastrophes.
One can only hope the momentum builds. Thanks for unpacking all these layers. It's been both enlightening and a bit mind-boggling how many moving parts there are.
Anytime. These discussions are key to understanding the interplay of market mechanisms, public policy, and risk management in today's climate reality.
Exactly, couldn't agree more. Cheers to a more resilient future and to innovative thinking that keeps pace with our changing climate.
Cheers indeed. And as we see, building a stronger, more adaptive system is not just about reacting to disasters, but about proactively reducing risks. Thanks for the great conversation. Until next time, stay curious and, prepared.